two distinguished panelists that have joined me today. I'm going to allow you both to make a brief introduction. Tim, if you will.
Yeah. Hi, everyone. Tim Rice with the Graham Company, insurance broker specializing in construction, local here to the tri-state area, and have clients up and down the East Coast.
If the slide is
I need that other one.
Worked as an attorney for about 20 years before coming to the Graham Company, which is a Marsh agency now. Despite being a New England fan, they still allowed me to participate in this panel. I worked for a number of years up in Boston. I ran the building department up there. I worked as assistant attorney general, worked for Tom Menino, and for the past 3 years, I've been doing risk management, taking all that experience from working in-house and in private practice in the construction industry and in advising clients. Thank you.
So as Alan mentioned there, we are going to be talking about subcontractor default insurance, talking about latest trends and claims, some areas of coverage issues that we've seen of late, opportunities for enhancement of coverage, either at the placement or renewal point, as well as certain alternatives for managing subcontractor default risk that we're going to be discussing as well. I just wanted to get a feel for the audience. Who here is with a general contractor or subcontractor? And what about owners or developers? Anyone? And are you folks familiar with subcontractor default insurance as a product, risk transfer? Yeah. Okay. All right. Good. So hopefully you come away with a bit more knowledge and some strategies here for coverage and claims.
And I think, as you take a look at this first slide, this comes from our friends from Guy Carpenter, which is a Marsh partner of ours, and the AGC. This is the why we're talking about this. So from this study that was polled here, the anticipated default risk is about 5 times increased from today till 2030. And you look at some of the main factors that are listed there. Some of them Jason touched upon with labor shortage, materials costs, et cetera. But obviously with this enhanced risk, something that, Richard, John, and I are tasked with when you're working with clients is, hey, can you tell me or can you see around the corner that I can't see? And this is something that has become a hot topic in the industry today.
And I think what's compelling is that the AGC just released this survey. And if you look at the top 4 or 5 things that are keeping contractors up all night, those are all the key indicators or causes of a default. So what is very distinguishing right now is that last time we saw circumstances like this, there was this tremendous infusion of government capital through the payment protection plan that is not present right now. So the inflationary pressures, while they're not as great as maybe they were, they're still present. The higher interest rates, and also like we heard in the last presentation, some of the concerns about labor. So these are all kind of brewing in to create a higher risk of default in the coming years.
And the interconnected nature of complex construction projects that we're seeing more and more of today lend itself to needing some sort of a risk transfer, risk mitigation product as well. So you don't see, or if you do see, a kind of a cascading effect from subcontractor defaults who have a backstop to rely upon.
Right. And I think at Graham, we have something we call the prime analysis. And what it does is it kind of builds a protective layer around your insurance policy so that the insurance policies are the remedy of last resort. And R is risk transfer in that prime. And that is critical to kind of driving the claims away. But what we'll talk about mostly now is the I, the insurance, and that is the SDI product and other products.
Tim, did you want to get into the who here as far as
Yeah, so generally who's using SDIs are general contractors. This is not a product that an owner would buy. It's a product that an owner should really encourage their contractors to carry. And I believe Marsh is coming out with a product that will be used particularly for owners who may be self-performing a large percentage of the work. But what it does is it provides a much broader scope of coverage than you'd find under a performance bond. It provides for a larger tail period. It also provides for things like liquidated damages. It'll pay the attorney's costs for processing the claim. It will pay experts if you need to have a delay expert come in and do an analysis to determine whether or not this default has a relationship to the maybe LDs you were assessed or maybe the delay costs you've incurred. The control, I don't know if anyone is familiar with what we call rectification insurance under your professional liability policy. That is a real strong tool for if you have real-time issues that you need to be get cash flow for to correct on the job site. This operates in a very similar way. This leaves within the contractor's control curing that default. And this is one of the reasons why owners should really look to have this, is because it keeps the project, it keeps the trains running in a way that other remedies would not. And the other thing is that SDI provides a tremendous opportunity to create another line of profit on your project if it is properly managed. They generally carry high deductibles, and that can be used as a pre-funded loss fund that if you have no deductible, if you have no losses, can go back in your pocket. SDI traditionally is about a half a point lower in terms of cost than you would find for a performance bond on the same thing. So when you're cutting, margin, when you're cutting pricing, it's something maybe you can look for. I know that a lot of contractors are increasingly using this. Marsh piloted something we'll talk a little bit about later, and it's a project specific. It's a new project specific, so it allows some medium sized and smaller contractors to now access the benefits of a program like this. In terms of the advantages, why owners should use it, the time element we talked about keeps the trains running. You don't want your project to be the one that people are looking at as a failure, and it mitigates a lot of the project risks in terms of making sure that there's the resources accessible to keep things coming. If things don't work well, it's going to be well beyond that of a performance bond. The performance bond is generally going to come up to what we call the penal sum. So for example, if you have $1 million contract and they've already got about $200,000 of work in place, the penal sum is only going to provide you about $800,000. The SDI product will give you whatever, regardless of how much work is done, it will focus on the volume of work you need to do to cure this default. And it will still be capped, but it will be in a much greater way than you'd find under a surety bond.
Move along here. So, John gave a great overview there of some of the distinctions between SDI coverage and more traditional performance bonds, payment bonds. A few additional points here. I think it was mentioned before, but SDI coverage, it's a first party coverage. It's no type of liability, third party claims. There's not going to be any type of defense if there's a claim asserted. First party coverage, GC is under most circumstances going to be your insured. You touched upon this as well. Control. It's really bringing the enrollment process all in-house for the general contractor. Those decisions are made at that general contractor level as far as what the scope of vetting is that's going to go on as far as the quality control process beforehand for subs. Obviously, there's to a degree it's going to be dictated by the carrier as well. But again, it's not a third party there as far as a surety that would be going through that process. Another point of control is obviously the decision on when and how to go about defaulting a sub itself. That's typically going to be dictated by your subcontract terms. And some of the points that Jason brought up earlier are absolutely applicable here with respect to the default process. So I want to be very clear on what that entails, and what that process is in terms of the subcontract itself. Claims as well. Just one thing to point out, the default itself is going to be that trigger of coverage under an SDI policy. You need that issuance of a default letter. That's going to in turn, you have a further notice obligation as far as providing that to the carrier. You'll see we're going to be talking about some pitfalls with coverage a bit later, but that notice period after the default is very important. Could be as short as 30 days. 30, 60, 90 days is typically what you see within the different policy forms, but It's a very short window there. There are certain other requirements, notice requirements that are within 5 days, I think, of the default. There may be some waivers of a co-payment on a deductible that may be available there. So you want to be very aware of any type of notice restrictions or timeframe there. Do you have something you want
Yeah,
to add there, John?
I think what's important about the pre-qualification, a lot of people find that as a deterrent. Most of the general contractors have a pre-qualification process of some kind where they're vetting, but a lot of the carriers now have a platform, a tech platform, where they'll pre-qualify a lot of the subcontractors for you. And to make sure that that is easy because it's to their benefit as well as the contractors to make sure that the right people are getting into that project. And I think what they're going to look for is they're going to look for financials. They're going to look for a WIP list. They're going to look for a lot of the things that you would imagine for underwriting if you want to know what kind of work someone is doing. How often are they performing the trade that you're going to contract with them for? Are they litigious? Do they have any other issues that you need to know about? What's their mod rating? Do they have OSHA violations? So, and then on the contract administration side, that's the same as like Rich was saying, be familiar with the contract. But you have documentation. That's why things like Procore and some of those other job site management tools are extremely important. They go hand in hand with making these policies very effective.
Efficiency is certainly an element of attractiveness of the subcontractor default insurance as well. Provides immediate relief, financial relief for general contractor on the project, keeping the project going. Avoiding those cascading effects of a default. We're going to keep it moving here because we're getting along in time. John or Tim, did you want to run through this one as far as the structure here?
Sure. Yeah, so the carrier, what happens a lot of times, this hypothetical is the easiest way of explaining it. So a lot of times the SDI, you can have coverage of up to maybe $50 million, $100 million aggregate for up to maybe between 75 and some carriers do up to 300 million of subcontractor value. So the limit of which you're insured would be up to maybe 50 or 100, 50 million occurrence, 100 aggregate. And the hypothetical explains, so for example, if you have a $5 million loss, you might pay a $1 million retention. So you're into this for the first $1 million. Then you're going to pay a co-payment. That's a 10% of that 5 million. So that's you're into about $2 million, $1.5 million before the insurance really kicks in. And then the insurance is going to pay about 3.5 million. So they say, well, I'm still paying out, but yes, this is an attractive vehicle to avoiding $5 million loss. But it's also, if you can contain the claims, it provides a nice pre-funded profit line in your project. But also you can use, as we'll talk about later, there's a tremendous growth in the construction industry of using captive structures to handle these large deductibles like you would on maybe a builder's risk or other maybe controlled insurance programs that may have large deductibles. The captive structures are a very, very effective way of getting two bites at the apple. So
Yeah, and that's another distinction as far as with bonds, right? You don't necessarily have that deductible, but in having that skin in the game, having that retention, it provides further incentive to really hone in on subcontractor management, right? And GCs have seen the benefit of that process as well.
And I think one small thing is we'll talk about default in a moment, but can you get default for relative? Do you have to terminate someone to access this policy? No, they just have to be in default. But what makes the economics of accessing that policy worth it if someone is defaulted is this structure. Are you going to meet that deductible? Are you going to exceed that deductible?
So let's get into coverage a bit further here. We've mentioned a lot of the components that I want to get into here to begin with, but again, SDI coverage, it's a first party policy, provides direct relief to a general contractor for costs that are incurred and arise out of a defaulted performance by a subcontractor. It's important that it be on a scheduled project. I was going to mention before those limits that you mentioned there, John, as far as 500 million, 300 million, that's not on a per project basis. That's kind of more of a rolling program where you enroll these projects specifically and schedule
Right.
projects. So again, there's both coverage for direct costs as well as indirect costs. Another distinction there from your bonds, your more traditional bonds. Again, cost of performance that are increased, any type of payment issues, um, delay damages. As far as the indirect costs, see there's extended overhead, delay damages, et cetera. Liquidated damages is going to be another component of coverage there. Again, all triggered by that initial default performance, that letter of default that's going to need to go out. So let's get into some coverage pitfalls here, things to be aware of to the extent that you're a GC or owner or a construction stakeholder. First and foremost, project contingencies and their impact on coverage. So there are a number of different policy forms, obviously, in the SDI arena, some of which identify and address by endorsement or directly within the policy form the impact and treatment of project contingencies, some of which will exclude and require that project contingencies that are carved out for specific subcontractors or specific scopes of work, they'll exclude and carve out those contingency amounts from the calculation of loss, therefore not make that portion of that amount of contingency recoverable. It's excluded from coverage there. And there are some what I'll call offending endorsements or policy forms that really don't even require that those contingency funds be utilized by the general contractor. The existence of the contingency itself is what triggers this exclusion and the requirement that those funds be backed out of any recovery. So you want to be aware of that upfront. And obviously, to the extent that you have an opportunity, negotiate further with that carrier prior to issuance of the policy. Keeping it moving here, subcontract loss multipliers. This is an issue near and dear to my heart. I have an ongoing claim related to the existence of an application of a subcontract loss multiplier. Again, there's a lot of different variation in forms. One of the issues that I'm dealing with is the inclusion of a subcontract multiplier, which is essentially a per project or excuse me, per claim loss limit. And the limitation that I'm dealing with wasn't included in, direct endorsement, wasn't included in the declarations page. It was really buried within the definition of loss itself. So unless you were really coverage counsel or somebody that enjoyed reading insurance policies, you're never going to see that until you have a claim that comes up. And then you realize that there's $2 million of loss that you don't have access to under the SDI policy. So something to be aware of here. This is fairly standard that you have a subcontract loss multiplier. It could be anywhere from 2 to 3 times of subcontract value, but just be aware that it's in there.
Yeah, I think the other insurance provision and is something you have to be careful of because it's a two-edged sword. You want to be able to take advantage of other other project participants' policies. For example, if there's a subcontractor and they've caused some damage, or general liability may cover that property damage or faulty workmanship, depending on what jurisdiction you're working on. Their pollution professional may cover something. So we're talking about driving claims away to protect that deductible so that it can be the profit line that it is secondarily designed to be. Obviously, it's for coverage first and then to increase profit. So, but the other insurance, there's a provision there, say if other insurance can cover something, then the SDI will not kick in. That's something like some of these other sharp pieces of glass that Richard's talking about in the policies. You really need to work with your broker on to massage this away to make sure that you can access the policy if needed. It's better to have it removed and than to leave it in.
Yeah, I think John and I differ a bit on how we look at this particular exclusion, or I should say, condition of provision. Um, uh, as coverage counsel, you don't want anything, any type of barrier or defense that's in your way from accessing here SDI coverage. Um, so while there are some benefits, obviously, that can be taken from it, again, as you mentioned, to the extent that you see a provision like this where it essentially makes the coverage null and void to the extent that there's other insurance that may be applicable to a loss, you definitely want to address that beforehand and try and negotiate. And as you said, massage the language there. Maybe instead of null and void, you make the coverage under the SDI policy sit excess to any other insurance that may be available.
But we do concur, removing this is optimal. But you want to keep in mind that there are other insurance policies that will still cover those claims to protect your deductible, but still, you don't want to have this in the policy.
Another one that's near and dear to my heart, insurer's right of recovery, clawback of payments. This can arise out of a number of different provisions within the SDI policy form itself. There could be language included within the insuring agreement, which most often requires coverage and a loss to be the result of the default itself. And you'll see language that to the extent the loss does not arise out of the default of performance, there's no coverage there. So again, the remedy and the benefit of SDI coverage is kind of that immediate relief. There is a process for submitting a proof of loss that's required, and a further RFI process that typically goes on by a carrier, and then payment is made. But to the extent that there's a finding of either no default or only a partial default that the loss can be attributed to that was paid out, your carrier is going to look to claw back a portion or the total payment that was made there. So one of the things I wanted to bring up was the subrogation rights of the insurer itself. So to the extent a payment is made under an SDI policy, they are going to look to seek further recovery from that defaulting sub. And you know, when that goes on, your carrier could step into your shoes by way of subrogation action, assert a claim against the sub. And there is somewhat of a conflict of interest there that I would like to point out. When that carrier steps into those shoes, they have the ability to make that recovery, but you absolutely want to stay to one degree or another involved in that process, because to the extent that the carrier is unsuccessful in asserting that claim and making a recovery from that sub, you're going to be on the hook as an insured for that remaining amount that was paid out. So be very aware of that. To the extent you have the ability to negotiate those terms further, absolutely take advantage of it. One of the recommendations I would make is to negotiate for the right to appoint counsel. That's obviously going to be paid by the insurer, that you can have involved in that subrogation process with any claims that may go on against that subcontractor that's defaulted. They would be there to obviously protect your interests in that process.
Yeah, sure. This is just to run through quickly some of the coverage issues. There are certain type of projects that SDI it was not designed to really do. Like, for example, it really doesn't like to do wood frame. It doesn't like to do some power plants or power energy projects. That is a big issue right now, given all the data center power projects that are coming up. But you can work with the broker about how to address that. Project value, like I talked about, some carriers may go up to as high as 300 million. Most of them like to be in the $150 million range, with a minimum threshold of about 75 million in subcontractor value to put into the project. And the project duration, it's obvious why they're concerned about that. When they're going out too long, they're stretching people out. Economics can change, and so can't the risk of default. There's a lot of professional liability exclusions because they're intending this is going to be a contractual risk. Professional liability is designed for something else. Bodily injury, that's another coverage. General liability, residential exclusions, They don't like to do a lot of residential projects similar to general liability. It's very critical that you work on the language that is in any exclusion for residential to make sure it still will be able to cover maybe the kind of work you're doing and have a very, very narrow scope. For example, if I'm just building for the homeowner myself. There's other things. If you're self-performing work, you want to make sure that you can include that as part of your project value. You want to watch the contingency and a couple of other issues that we've talked about earlier.
Let's, I'm going to skip over this here. There's tips and takeaways that I'd like you all to be aware of. Obviously, these slides are going to be made available to everybody, but we're getting down to it. I want you to cover this project-specific SDI product that's becoming a bit more popularized now.
I think this is Marsh piloted this with a carrier, and it is now available. Normally, it was for larger projects. It will be written on $25 million in subcontract value, which is about $50 million less than what they typically would look at. The limits are less, but it's still, when you do a comparison compared to a performance bond, still provides the opportunity for a loss fund, still provides an opportunity for expanded coverage. And it can go for 2 projects you can combine to try and get that $25 million in value. And as you can see, we were talking before about multipliers. There is a 125% claim limit of the subcontract value, but that doesn't matter how much work has been done. They'll still give you 125% of the subcontract value or $2.5 million. So there's different deductible levels. There's no co-insurance. So it's really modified for the smaller project. If you're doing a $100 million project and having larger subcontracts, it may not be the best one because of the $2.5 million, but it's a new product.
We're going to need to run through these last few slides here.
I can take that real quick. So, everyone's hearing about captives a lot and increasingly in the construction industry. I think a lot of people think of captives and they think it's dividends and vacations in Bermuda. But the reality is everything that, Richard's talked about, John's talked about, Jason and Joshua before. If you get yourself in a place where you've done your pre-qual, you've done your loss control, you've worked on your risk transfer and indemnification, you've gone to a point where you are a best-in-class risk, you should start to look at the mechanics of what insurance carriers do. Now, insurance carriers, they're for-profit entities. They're very successful. You can take a look at their stocks and their revenue. But if you get into a place where you can act just like them, why not become the insurance carrier? Now, most construction owners and GC clients did not go to school to be an insurance owner, but we can utilize the same mechanics and fundamentals that they do for either paying out claims or deferring on revenue payments as well through a captive structure. The most claims can take 3 to 4 years or more to actually be paid out. Why isn't that an escrow for yourself? And why aren't you accruing interest on that as well? And if you perform well on that project, why aren't you getting that back as a dividend just like the insurance carriers are? So something to keep in mind, but you cannot rush into this. You have to get everything in line.
And this would be just for the deductible portion. You saw that $1 million deductible portion. The SDI carrier would sit on top of that. The captive structure, you would develop that for the deductible. That's how you get 2 bites at the apple for the money made.
Both Tim and John are going to be here afterward. So will I. So hopefully we'll all get a chance to catch up and talk about this further. But thank you. That's more than our time.
There was one last thing that we talk about trade credit insurance for upstream risk. And that's for people who you're getting paid by. That's a growing area in construction as well.